All right, welcome back, everyone. It's a pity that I get you as the 8th presentation. You're all exhausted. And I want you to think about something that many people don't like to, except for Stephen maybe. But I'll do it anyway. That's my challenge. So basically what we're going to study today is the accounting equation. I'll get into the objective and what it means in a moment. I have a couple of questions for you. Have you ever run a business?
Yeah.
Ever? Okay. Okay. And what kind of transactions, financial transactions, you handled in the business? Maybe it's a silly question, but some of us are trying to learn here.
Well, accounts payable, receivables.
What are they? Payables and receivables, you say?
Yeah. I'm not sure what else there is.
Okay. But he nailed the coffee right at the head. I mean, you pay money that you owe to other people, and also you get money that other people owe to you. That's basically a balance. That's how you keep afloat. What happens when you have more money going out, less money coming in?
We open one.
Exactly. Your boat sinks. You don't stay in business for long. It has to be the other way around. Money comes in more than money goes out. And also, those of you who know a little bit of accounting, the speed should be dissimilar as well. Money should come more at a faster speed. Otherwise, that can also lead to problems. The reason why I'm asking these questions is to establish the fact that accounting is important. If you call a business as a body and the blood as the cash or money, however you put it, accounting is almost like the heart, in my opinion. And even if you don't like it, even if you don't like it, I'll say it. That's how I feel. It's all anecdotal, okay? It's not from the book. Accounting is the heart of the business. You have proper accounting, chances are rest of the body is working well. You have poor accounting, you're getting to bankrupted. And I have friends, and I'm sure you have friends who had foreclosures and all kinds of problems with their financial activities because of poor accounting. Okay? So what we're investigating today, we're going to try to understand the accounting equation, number one, and also how the basic transactions, receivables and payables and other things, these things impact the accounting equation. It's very important that your takeaway from here would be what accounting equation is, what are the components. First of all, since we're talking about accounting, what is it, basically? Look at the underlined marks. This is from Merriam-Webster. I could have taken it from a book, but still, I mean, who goes to a book to learn definition? It's a system that handles business and financial transactions. I also call it a philosophy. And in my class, I also tell people this is a different language. It is the language of business. It's a language, period. So what you're learning today is the ABCs or alphabets of the language, in a nutshell, okay? And those of you who have already learned this, bear with me, just pretend, okay? This is the Holy Grail, the accounting equation in purple, okay? Assets, liabilities, owners, or shareholders' equity. You gave me an example of receivables and payables. They can fall under one of these three categories. I'll get into that in a moment, okay? First of all, what are our assets?
What you own, I guess.
Something that you own, very good. It's very important you own it to begin with. You own it. What else you do with your ownership?
What was the question?
What else do you do with your ownership of the assets? I mean, how do you use them?
Why do you own them?
Sorry?
Why do you own them, to ask it a different way?
Exactly. So why do you own them?
Oh, you're talking about like tools, physical things.
Sure.
Like a company van, let's say, if you had a service company.
Company van, what do you do with this?
Well, you do the work with it, like you drive to the work.
The point is you draw some benefit out of it. It has some economic benefit. So by definition, an asset is something that you own and something that you can draw economic benefits from. The company van, the equipment, the building. You're forgetting the most basic type of asset.
I don't think I ever knew it.
Money.
Thank you. The money, cash.
Oh.
In accounting, you don't say money. You say cash. Okay.
Dollar bills, y'all.
Yeah, dollar bills, plastic money, credit, the cash. We're not getting into credit to mess things up. Cash, the very basic type of asset. Okay, what are the liabilities?
Accounts payable.
Very good. By definition, it's a payable. You need to pay, you owe. You gave the definition of asset that you own. Here, this is something that you owe to other people. And also, they have a similarity. Both of them actually have some economic benefit. What could be an example, another example of a liability?
Mortgage.
Very good. What do you do with the mortgage? Get some money by setting your house as a mortgage to the bank and use that money to some economic benefits, right? So these two actually bring economic benefits. This is what you own, this is what you owe, right? The balancing act is, there should be some difference in these two, and the difference would be the owner's equity. People ask me this question, oh, give us a better definition. No, I won't. The difference between the assets and liabilities is the owner's equity. There's a reason why we have an equal sign here. It's algebra. Folks, go back to your elementary algebra. It's algebra. You cannot put an equal sign on something if these two sides are not equal. So the quickest definition of owner's equity would be the difference between the two. However, it says shareholders' equity, so we have some clue about this. What could be an example of shareholders' equity?
Money to put in the business to either to keep it running or to buy equipment or.
Okay.
So you put money in, buy the equipment keeps it going, helps you to make money,
Uh-huh.
and then that sits off to the side waiting until, down the road, when you turn it on profit, you can get it paid back.
Exactly. Now, you can also do all these things with your liabilities, but the difference is you actually own the company or part of it. So, the company is asking for your money, you say, oh, give me 10% share of the company, I'll give you $100,000. Same money, same cash. It stays at the bank, looks the same. However, it's owner's equity because now you are an owner. Okay? Being an owner, you can also be subject to getting dividends at the end of the year. Okay? The net profit that you calculate after taking out the expenses from the sales, that is also added to the owner's equity. If the company is doing well, this goes up, the share price goes up. Okay? It's a remarkable thing. How it works, it takes time to sink in, but it will. It's just that not in 10 minutes. Okay? All right? Shareholders' equity is also impacted by the revenues and expenses. Why? I just mentioned the profit. Net profit is basically the difference between all the revenues and all the expenses. In a nutshell. Okay? Now, I want you to practice this. There are 3 transactions here. You're selling vacuum cleaners, okay? And you don't have to be in a group or anything. Just raise your hand and try to answer. Identify the assets, liability, and shareholders' equity in these 3. It is the end of the pay period, and now you have to pay your salespeople their salary. Is it an asset, or liability, or owner's equity?
Liability.
Liability. Payable, it's actually payable. We call it salary payable, wage payable, however you put it. Okay? Vacuum cleaners available in your store. You're selling vacuum cleaners.
Asset.
Thank you. The other name of this is inventory. Thank you. Inventory. How about this one? You have made 10% profit this month. Who owns this profit?
You.
She does. She bought the share, 10% share. She gets 1% out of the entire profit. This is shareholders' equity. Okay? I think you got the basic idea of these 3 categories, right? I have the answers here, but you guys don't need it. Okay? It's all about the balance. A balance. I want you to take this out of this class. Okay? Think about a physical balance. We don't see these balances anymore. The closest thing I saw at Superstore is half of it, and I hate it. It should be like this. When we were young, we would have this kind of balance. On one side, we would have weights, and the other side, we would be having whatever we're trying to weigh, right? This is what I want you to take. This is the statement that handles this, forget about the balance sheet part, I didn't want to tamper with the things here. But you have assets on one side, liabilities and owner's equity on the other side. If you take $10 out of asset, you have to take $10 from here, somewhere. You put $10 back in here, your liabilities didn't go up. What goes up then? Thank you. Your share value went up because you got more asset. That's how it works. Does that make sense? Okay. How am I doing with the time?
4.5 minutes.
Very good. We have time for activity. These are basic transaction types. It's not off topic. You want to understand the accounting equation, you have to know what are the basic types of transactions. So I have the 5 basic types, and there can be dividends you can throw in as the 6th one. Still, it behaves the same way as expenses, so I'm keeping it. One of the ways of remembering it would be ALORE. We know assets, liabilities, and owner's equity, and these are the 2 other items. Revenues or sales, however you put it, and expenses. These are the 5 basic categories. So anytime you see a transaction like this one, okay, common shares are issued for $250,000. There has to be 2 impacts. The beauty of accounting is, based on this equation, anytime there's a transaction, there are 2 items that are impacted. At least 2 items. Can be more. So, common shares are issued. What does that mean? Sorry? Very good. $250,000 worth of owner's equity. It went up, right? So what is the balancing act? How? Okay. It does not say anything, but we assume that this is cash that you got. $250,000 added to the assets as cash. That's how you finance the operation. They ask for the money, you get it. So nice of you, Carol. Does that make sense? Okay. So I have 3 transactions here. I want you to pair up. So the 2 of you, the 2 of you, and the 2 of you, and you and I can teach it. Because you don't need this.
I'm good with it.
Take number 1, team number 1, team number 2, and team number 3. You're 2 and you're 3. And tell me, or write down on a piece of paper, and I'll show you the answers in a moment, how these transactions are impacting the accounting equations. You have 30 seconds, because it's a piece of cake for you.
Could put on a,
Yeah.
we could debit equipment.
So we're assuming January's already
Don't
done.
worry about that. You just lose your assets, basically your balance.
Paid,
As you take
you
your
got
assets as your
paid.
cash,
Great.
so your assets down, goes up, so you're on the balance. And just take $200,000. If you were.
If it's not cash, if it's not asset,
Take out a
asset,
balance.
if
Your
it's
cash
not
goes up.
something that you
Oh,
Next
or
day,
3.
The first
Or your 3.
chances are it's
Yeah,
one of
company
the
needs it. So the cash goes
expenses
down.
and things, owner's equity impacted by
So you have
this.
2 assets.
Right.
So
Cash went down,
here,
equipment went up. No change
paid
in
that
assets.
much in cash,
Oh,
cash went
okay.
No
down.
change in the
what I
total
said.
assets.
Your asset.
That's
Just
your
exchange-
rate, sorry, I
So you
didn't.
have to
One
do
asset
something.
for another asset. You just trade it.
That's the way. Take something out from
Well,
liability.
your liability goes down.
Okay, so rent payable was there, and now you have
Yeah.
less rent
You
payable.
take it out as a
All right,
liability.
how are you guys doing?
Yeah, the bank loan is a liability.
Okay,
The liabilities went up, so we have to figure out a way to more, bring in more cash.
uh-huh,
Because that's a bank loan, so that's a liability
uh-huh,
as opposed
As
to
opposed to
equity.
equity.
Uh-huh.
Yeah.
uh-huh. What about you guys? Paid that much?
It's,
for
well,
equipment?
it evens out because you take the cash to pay for the equipment, so it evens out.
Very good, on the same side. Now, check this out. The first one, taking out bank loan for $100,000, it's cash, your asset went up by $100,000. Number 1, $100,000 up. Okay? Your liabilities also increased. This one also increased by $100,000. Right? The next one, assets decreased because you paid out. So, number 2, $1,100 gone down. Shareholders' equity, retained earning decreases. Why? Because actually it's an expense. And remember, we said expenses and revenues, ALORE, the last two, revenue. These two impact the equity. This one is a little tricky and you need a little bit more background on this, but here, because this is going down, you have to also reduce the equity by 1.1K. And the third one, again, cash decreased, and this is really remarkable, by $650,000 or $65,000 because you purchased equipment, but equipment went up. So the change is happening on the same side. Do we have the balance? That's the important part. You have to have the balance. Any questions about the basic idea of accounting? How are you doing with the time? Nice. Thank you. If you give me like a couple more minutes, I'll share the life-changing thing that he's teaching us about, because I couldn't fit it in here. The lesson was more important than my life.
Not so.
Let's do it. 8 years ago, when I first came to Canada, I tried to start teaching somewhere, and I sent emails to 8 different organizations, and probably Nate was not one of them. And the top one was McKeon in my choice, and I was living like 10 minutes walk from McKeon. Guess what? I got a job at McKeon teaching. Okay. This is an off topic, but they gave me to teach diversity and intercultural communication.
Cool.
I didn't even know what it was. I just said yes. I wanted to be in the system. That course taught me a lot of things, but that's not the point. The point is, they asked me what you want to teach. I said, well, I love accounting and I love managerial accounting. They said, you will never get it because you don't have the certification. Okay? Fast forward 7 years. Last year, I was hired to teach quality for 2 semesters. And all of a sudden, Joe, the chair, came to me and said, hey, what did you think about teaching accounting? I said, I love it, but you won't give me, because I don't have the certification. He said, go for it. Because we don't have to have the certification, because it's BTech, it's not the accounting department. Guess what? After teaching it for 1 semester, they have a position open that will be the lead in the financial accounting course, and they have to change it. And they interviewed me, and that's how Deb and we got in. She got in HR, and I got in accounting. So I'm primarily hired as an accounting instructor, and I won't tell you how less I know about it. This is life-changing. Something that I assumed that will never happen, but I had a passion for it. Now I'm doing it. I'm living my passion. And I'm not even an accountant. In my class, mostly, none of them are accountants, so I'm all by myself. I say, hey, I'm an engineer doing an MBA with a PhD in patient satisfaction teaching accounting. How confused can you be? So, just wanted to share this with all of you. This is who I am. I mean, I've been all over the places, and this is my new home. I don't know for how long they will keep me, but we'll see if I can sustain in here and go for your passion. I mean, the certification is the law, rule, regulation, but at the end of the day, look at me. How did I survive? I don't know. I believe in the Almighty and His will. He wanted it to be this way. And now I'm doing what I love to do. Thank you.